National debt ticked over $40 trillion for the first time. Why do you think bonds might be concerned? Why do you think there might be a demand for a higher interest rate? We've never had debt this high. See how this is all kind of tying together and kind of snowballing on itself. Good morning. Welcome to Life in the Markets. My name is Tim Russell, and we're here with the Life Financial Group helping Christians become even better stewards of all of their assets. Today is Monday, August 24th, and I don't know how things are where you live, but today seems to be the first day of school for all of the kids running off to start their new grade, their new year. Roads are full of buses. The skies are beautiful. The weather is about perfect right now. And this is peak summer. I know it's peak summer and kids are starting to go back to school. That's just the way it is, kids. Well, this week, we want to talk about a number of things that happened within the market. But before I get to some of the commentary, let me just tell you where we ended up over the past week. By and large, all of the major indices were lower this week. So we have the S&P down just shy of 1.5, the equal weighted S&P down 0.45 technically. The NASDAQ was our big loser, off about 2.5% for the week. The Russell 2000 down 1.65, and then the international market's actually holding up better than the rest of the U.S. market, only down 0.33%. We look at gold. Gold was up, silver was up, oil was up. Bitcoin, if you care about that, a really sharp increase in the price of Bitcoin over the past 5 days. It was up almost 25%. That's remarkable. However, note that year to date, it is still off 10% from where we started the year. Just goes to show Bitcoin is an incredibly volatile investment or asset or whatever you want to call it. Bonds. Bonds were down a little bit this week, just ever so slightly, down about 0.13. So that's the aggregate bond that measures most of the corporate bonds here in America. And the high yield bonds. High yield bonds generally are bonds that are a little bit more risky, companies that may have a little bit more credit quality concerns. Both of them are roughly sitting at the same number. However, year to date, we are seeing that high yield bonds are actually doing better than aggregate bonds. Then looking at the 10-year Treasury, we're going to talk about the 10-year Treasury a little later in today's episode. That was up 0.5%, about actually 0.6%, showing a very marked increase in the yield on the 10-year Treasury year to date, just shy of 14% increase in the yield. That in and of itself does not necessarily tell you anything. No one made money on the 10-year Treasury because it's up 14%. In fact, the opposite is true. You see, we're actually down 2.5% year to date on the ag bond index. All of that is really just pointing out the reality that as interest rates rise, it does cause some concerns, some problems for the overall bond market. Let's dive in to what was driving the markets this week. The first thing, we're going to talk about bonds. Why in the world are bonds so important, Tim? You seem to talk about them a lot. I invest in the stock market. The stock market is a lot more interesting than the bond market. I mean, you know, we're sitting here and all of the 0.13% decline on the week does not sound like something worth talking about. Well, there actually is a lot going on. Technically, the bond market is larger than the stock market. There's more money at play within bonds than there are within stocks, which means we should probably be paying attention to them because what happens within the bond market has a lot to tell us about the overall strength of the economy, the consumer, and companies in general. So what exactly did happen? First of all, lay of the land. We've talked about this before, how we have a new Fed chair. We've got Warsh in charge, and he's the new sheriff in town, and he's got a different approach. He's got a different approach to how to talk about what he's thinking, as well as how interventionist he's going to be with supporting the economy and propping things up and making sure assets go up in value. He's much more content to allow market forces to drive the market and to then step in and intercede when it's necessary. So not trying to have his hands on it at all times. It's a very different tact. Frankly, it's one that I think is refreshing. I think it'll be healthy for our overall economy to have economic forces driving some of the decisions more than fear of market reactions. Let's let the market actually function. It's a good thing. Well, the Treasury Secretary, Bassett, said, actually came out this week, and instead of kind of taking Warsh's cue and following his pattern, what we're seeing is with the Treasury is going out and trying to prop up the longer-term bond market. What's happening in the longer-term bond market is this week, and we've seen this trend over the year, is that the longer term, this is the 10, the 20, and the 30-year bonds, the Treasuries, the interest rate on those bonds has been going higher and higher. What Bassett is trying to do is force those interest rates lower by buying a bunch of them or trying to push the interest rate lower in the overall bond market. And that sounds like a fine idea, sounds like it could be a good solution, but it really didn't do anything. I show you here, I've got a chart of the 10-year Treasury. This is a continuing, 10-year Treasury, what those yields would look like. And you can see this is just over about a month's worth of data here. Just this week, there's that little circle there. It shows where the Treasury stepped in to push rates lower, and it was successful. It was able to get the 10-year Treasury rates down a bit, but after they stopped supporting and propping up that market, guess what happened? Rates went back to normal. So the market is going to do what the market's going to do. The interest rate reflects risk. The interest rate reflects concerns. The interest rate reflects the fact that this week we had the overall debt load in America over $40 trillion for the first time. National debt ticked over $40 trillion for the first time. Why do you think bonds might be concerned? Why do you think there might be a demand for a higher interest rate? We've never had debt this high. What's interesting is that the last time we ticked over one of the major 10 numbers here from $30 trillion from like in the 20s into the 30s, that was 4.5 years ago. We jumped 33% increase in the national debt in the last 4.5 years. That is very remarkable. Obviously, it's a very bad trend. We need government spending to slow down, not accelerate. We got to get people off of the dole of the government and cause Americans to get out there and be economically productive in our economy. I know that there are people who have hard times, and there is a place for some social safety nets. I'm not saying we can't have them. I am saying that we can't let them be abused. We can't let them be the default option for someone who doesn't want to work. We do need to do something with our national debt. I would love to see us ending this conflict in Iran. That's not helping our national debt situation by any means. Let's stop growing the debt. Let's actually start whittling it away. That would indeed be a good thing. A couple earnings spotlights that I think are worth mentioning. We did have the Walmart, one of the biggest retailers, actual brick and mortar stores in America, if we aren't counting Amazon, which doesn't have much in the way of brick and mortar. Walmart had an earnings report, and the report was a little bit disappointing this week. What it shows is that middle Americans are making different trade-offs in their purchases. They're going for one set of thing rather than another set of things. Their budget is feeling stretched. This is because of inflation. This is because of economic pressures. This is because of maybe the price of gasoline. There could be a lot of factors here, but we are seeing Walmart indicate some early pressure here, some stress on the average American who's going to Walmart buying the kinds of things they're doing. Their revenue was down, which means their profit was down, which Walmart's still a very profitable company, makes tons of revenue. But we are seeing some signs that maybe the consumer is getting to the point where they can only take so much with their limited resources. Obviously, this is going to affect the buying habits of Americans. And one last story to wrap up the week. We had oil jump another 5%. We actually saw a lot of commodities increase this week, but oil jumping 5% certainly is not something that anybody wants to see. The price of oil ended the week at $86 a barrel, $86.63. It's a lot to pay for a barrel of oil. That obviously, as we've talked about with Walmart, as we've talked about with, some of the other factors that are going on globally with interest rates, bonds, the economy, having oil where it is going to cause some pressures on consumers, which is going to put pressure on the economy, which is going to cause interest rates to go higher, which means the government's going to have to borrow more money to be able to actually not borrow more money. They're going to consistently be borrowing more money, but paying more interest on the money that they borrow. That's what I meant to say, because interest rates go up. And as the amount of interest we're paying just on our bonds increases, that's a problem. Oil is not the only cause here, but it is certainly one of those things that's causing pressure on interest rates, causing more interest payments for the government, causing the debt load to increase. You see how this is all kind of tying together and kind of snowballing on itself. Again, go back to this war in Iran. While I agree that there may have been very good reason to get in there and to do some things, and I would very much love to see a change of the regime here, praying that would happen, I would really love this war to come to an end so that we can kind of get this behind us, get our economy back in shape, right-size our spending so that we can properly grow our economy the way that we're supposed to do it. As we transition, we're coming to the end of the episode. Next week, we've got some interesting earnings reports coming out. We've got the Jackson Hole symposium that's happening Friday, Saturday, Sunday, or at the end of the week there. I think there could be some very interesting economic news that comes out of that. I don't know whether or not we'll be able to report on that when we get together on Monday. But I will say consumer sentiment, we're also going to get another read of that. So we'll keep an eye out for next week. You want to tune in to find out more about what's going on. Let me close our week with a verse. This is a verse from Luke chapter 16, verse 10. And I love this verse for all of you out there who are trying to grow and invest and save. And you're kind of struggling. You're like, I feel like I could be doing more. I could have more. Be content. Be content with where you have it. And listen to what Jesus tells us here in Luke 16, verse 10. It says, one who is faithful in a very little is also faithful in much, and one who is dishonest in very little is also dishonest in much. Rather than focusing on how much more you wish you had, on how much better you thought you could do, focus on faithfulness. Be faithful where you are. Be faithful with as much or as little as you have, because God promises that those who are faithful with little will be faithful with much. In fact, I believe will be entrusted with more. But if you're going to be dishonest, if you're going to lie, cheat, and steal, that is going to also impact what you do with more. So be content with what you have. Be faithful where you are. Keep on looking to Christ. We talked about the markets and the economy and things going up and down and things sounding like they're out of control. Nothing's out of control. Jesus is fully in control. You can trust him. Trust him with your life. Trust him with your heart. Give him your love and your faith. Your life will never be the same, and you'll be eternally grateful. Until next time, take care, God bless, and be safe in the markets.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management, member FINRA and SIPC.